Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. All right, so the end of the year for me is all about the expectations of the Fed cutting rates early next year and the reaction that we've seen from US Treasury yields. They have headed lower dramatically in November and December. Coinciding with that, we've seen the US dollar drop significantly during the past 2 months, and market breadth dominated by US large cap, mega cap stocks, technology stocks, think Magnificent Seven, pretty much the entirety of 2023. That's one of the big themes of the past year. That has quietly been changing since the beginning of November as rates have headed lower. Let's discuss that. So we have on the chart here 10-year US Treasury yields. Okay, these are the yields that US government bonds are paying. You can see it has dropped significantly. It was up near 5%, now significantly down below 4%. A lot of this related to the fact that expectations are that the Fed is going to start cutting interest rates in late first quarter, maybe early second quarter of 2024. It's a little bit too early to tell. Things can obviously always change, but that shift in expectations have caused interest rates to come down significantly from their previous peak. During this period, we've seen longer maturity bonds. Remember, bond prices move inversely to yields, and we've seen longer duration bonds, longer maturity bonds outperform cash in a way that they haven't really been doing for a lot of 2023, and especially last year when rates were increasing dramatically. Now, coinciding with that, remember, US Treasury bonds are purchased in US dollar, right? They're denominated in US dollars. So this is not unrelated that we're seeing the demand for US dollars decline as rates make bonds a little bit less attractive in the US. That's part of it. There's a lot of factors too. But it's down 3.1% over the past several weeks. We can see here perhaps some implications of this, obviously related to treasury rates, but this also could have an impact on some things like commodities that are dollar denominated, or even those countries like emerging markets typically are helped by a decline in US dollar, and that could help emerging markets equities, which have struggled for quite some time. So keep an eye on international markets with that dollar declining. So last takeaway, I've got two slides here, but this has been the theme of 2023. Magnificent Seven have dominated 2023 performance. We can see nearly 70% year-to-date return for the 7 big tech stocks. You can see these are the transformational companies. These are the companies that finance long-term debt at pretty much 0% interest. These are the companies that have artificial intelligence initiatives. These are technologically advanced large companies that have really stood out there on an island by themselves in 2023 with the performance that they have generated. Everything else, look at that. The remaining 493 stocks in 2023 are up less than 10%. So this has been a very narrow market rally in the S&P 500 and US equity markets throughout the year. That has been the theme all year. That's been the knock on this rally all year. But what's changing? We talk about interest rates effect on the US dollar. Well, it's having an effect on the demand for which stocks people are buying. Take a look at this chart. The S&P 500 total return percent change, that's in the purple. This is since the beginning of November. You can see in the orange is the equal weighted total return index. So what is that? Why do we compare those two? Well, you've got the S&P, normally it's cap weighted, right? Larger companies get larger weights. That's the line in the purple. That has been what's dominated all year long because those big cap companies that we just talked about have been outperforming. But if you put all those companies on an equal playing field, you say, hey, Google, you're equal to a really small cap company that's 1/100th of the size of you, right? Equal playing fields. Just take a look at those returns. That's where we're seeing a lot of those stocks, those remaining 493, those are dragging down that return. But as interest rates have declined, right, the US dollar is declining, but investors are also starting to find small and mid-cap companies more attractive. Why is that? Well, typically as rates cut and they rebound, you're going to start to see potentially that decline start to hit some of those growth stocks which are financing a lot of that growth. And you're starting to see perhaps a little bit more attraction to value in the small mid-cap names. Market breadth significantly improving in anticipation for the Fed to start cutting interest rates. And finally, obviously, it's Christmas week. We've got the New Year's coming up, busy time of year for a lot of different holidays this year for everyone. So I want to first say happy holidays. Thanks everyone for watching. But if you look at travel season, anticipated to be about 6% more busy than it was last year. A reminder, 3 busiest days of the year. Typically last year it was the 29th. This year is forecasted to be the 21st, which was yesterday, December 29th, and January 1st. A lot of people traveling for New Year's Eve, traveling right ahead of Christmas. If you're out there, probably get to the airport a little bit earlier, be patient with everyone, enjoy your visits with family. I want to, again, thank everyone for watching this year. We've had a lot of fun and a lot of enjoyment in sharing information and insights with you from myself and everyone at Meeder. I want to thank you for watching, and I hope you have a very safe holiday and a great new year. Thanks again.